The show, Mike Lee of Mike Lee Strategy. Thank you very much for taking the time today, Mike. They're still gung-ho, aren't they?
Well, look, I think the market is so far ahead of the Fed. And for Powell to say that they're going to become data dependent and that they're not on a preordained plan has sent the equity markets wild. It's massively inverted the yield curve. And so, the talking heads out there are trying to conduct policy by shooting their mouths off, which I have to say it started last fall and this spring, and the front end, the 2-year got to 3% plus much quicker than the Fed actually raised interest rates. And they did take a lot of liquidity out. They really slowed down the housing market, which I would say is one of the good things that the Fed has done this year. So I think they're out there trying to create this guessing game that I wasn't working during that point, but I gather it's how the 90s were, in that Greenspan kept everybody guessing. You need markets to be two-sided, not interest rates at zero forever and completely telegraphed in everything that they do.
Well, it goes back to my, that strategy of over making sure everybody knows too much. I think sometimes transparency is overrated, right? Because it gets people leaning to one way or another, trying to steal second base when they still try to have their foot on first. I don't like that, but you're right. And to your point, though, yesterday, a big sell-off in the market, over 400 points if you're looking at the Dow, and basically today we've got it all back. So we've just gone around the block for nothing. And there really hasn't been a change in any strategy, right? Or anything the Fed has said. Well, the Fed said that they'll continue on this rate hike plan, but that would have slowed things down. But it really hasn't, has it?
Yes. So I think most people that have been watching what's going on, reasonable people, not just the Fed governors, inflation, the strength of it, how much it carried into this year, and the fact that the supply chains haven't got much better, and oil prices skyrocketing. So we knew inflation was going to be high. We knew the price of oil was going to go higher, and we knew the economy was going to slow. I think very few people that talk a lot like me really understood the degree of all those factors. And as a result, the economy has collapsed much quicker than most people would have thought. And I think that's why the market went down 20+% in just a few months, while the bond market was down over 10% in that same time period. So, this has been playing out in the markets. And I think what the markets are telling us now is that by sometime next spring of next year, the Fed's going to start cutting rates, and that the economy is going to start recovering at some point next year, and will bottom at some point, I don't know, in the middle of next year, the end of next year, something along those lines.
Do you think they got to be careful, though, about saying that they're going to hike too much and actually go do it? I mean, if we get a 0.5% hike in September and then maybe another one in November, I mean, I think the real risk here is they overshoot, right? Because they've got a dog, it's like a dog with a bone in its mouth. They won't let go of the fact that they want to get out in front of this inflation. They've got some sort of point they want to prove, and I think that that's the risk, because I feel as though things have really shifted underneath their feet faster than I would have thought too, up until today. So anything from here on out, I think you'd have to be very, very careful.
Well, look, I would say if I'm the Fed, I want to overshoot. Okay, we've had over-accommodated. The policy's been too accommodative since 2010, right? You added a $9 trillion balance sheet. And as you can see, with just some verbiage change, in the blink of an eye, equity markets are up 6% higher. We're too reliant on the Fed for our financial markets, for the way everything works now. I would actually like to see him overshoot, not by 100 or 200 basis points, but maybe a couple of rate hikes, so that inflation does get under control. Because when you could look at a recession, or you can look at persistent inflation. Persistent inflation is not only bad for markets and economies, it completely tears societies apart. So if the Fed overshoots a little bit here, and the recession's a little bit longer, a little bit deeper than it could have been, I would say that's a better alternative to inflation lasting longer. I don't think what the Fed accounted on is the climate zealots in the White House driving the price of gasoline to $5 or $6, gasoline above $5 and diesel above $6, and the effect that the cost push that's having on everything, and the lack of action, particularly by Mayor Pete, who's in way over his head, doing absolutely nothing for the supply chain. So, when they're back there modeling, they expect, the people in charge to be rational and intelligent, not left-wing zealots that came out of some library at some overpriced university. So there's a lot of things going on here, but in terms of overshooting, I respectfully disagree. I'd like to see them slightly overshoot. I'd imagine that's going to happen.
Well, that makes sense now that you bring it up, and I think I really appreciate that because that has been a problem, and I'd rather have no inflation. I just wonder, how quickly do you think this inflation will really come down, though?
I'm the wrong person to ask. Well, in full disclosure, I was on Team Transitory. And I really started getting nervous December, January this year about this. I think you're looking at a pretty parabolic economic collapse, and unemployment is the next shoe to drop, in my opinion, in that, well, you already had the lowest consumer confidence number on record.
Yep.
With credit card debt hitting an all-time high, while simultaneously the savings rate hitting, the lowest it's been since pre-2008 financial crisis. So the consumer is just getting crushed, especially on the lower end. They're making a choice between food, rent, and gas. Right. And your viewers and you guys will know what the food that we haven't seen the real food inflation and the effects from this war in Ukraine, which we'll only see this winter. So if we don't get some relief on the gas front, and I don't think we're going to see any relief on the rent front, it becomes very difficult for a lot of people. So right. I as our friend Jim Iorio says, one of the cures for higher prices. So the bottom falling out of this economy, I think, has surprised the Fed. It surprised a lot of market watchers, and I think that's in turn why you're getting this bullish reading on interest rates going nowhere near as high. So hopefully inflation really tames down soon. You're starting to see it in some of the ISM survey data. Okay,
that's excellent stuff. You're right. We did see that. Thank you very much. That's awesome. Michael Lee from Michael Lee Strategy. Really appreciate you coming on today. He's in Sarasota. Let's take a look at those real quick at these equity markets.